Principles of Finance with Excel Modeling, copyright Lou Gaddis. Topic 1, Financial Statement Analysis and Forecasting. You can follow along a lot of these topics in Chapter 1 and Chapter 7 of Principles of Finance with Excel, 2nd edition, by Simon Benninga. In this topic, we're going to understand the types of problems that financial managers solve. This is the first topic in this series. We're going to design financial models using appropriate styles and organization of a good financial model. We're going to forecast an income statement, a balance sheet, and a particular type of free cash flow statement. And we're going to compute financial ratios and common size financial statements. Before we start this series of topics on financial modeling and analysis, let's talk about the types of problems that financial managers work on. Well, first of all, you can think about finances in 3 general areas: corporate finance, personal finance, and investment management. In corporate finance, you're solving corporate financial problems, namely investing, financing, and planning. So in that areas, you'll talk about what projects should firms choose. That topic is called capital budgeting. How much funding does the firm need? That topic is called financing or financial forecasting. Should the firm borrow or issue stock to finance growth? Again, that's capital structure. Should the firm buy or lease equipment? This would be capital budgeting and financing. And what is the firm's projected earnings? You might need this to apply for a line of credit or talk to your investors. And what is the risk of bankruptcy and how can risk be mitigated? This topic we can generally call financial risk management. Now, in personal finance, you're also helping individuals or people solve financial problems. And again, they're financing, investing, and planning problems. So you answer problems like, am I saving enough for retirement? How much life insurance do I need? Is an MBA a good financial decision? Where should I invest my savings? And what return should I expect from my investments? These are types of problems that we'll learn to answer in these topics. And lastly, investment management. Investment management involves pooling funds. In other words, you can collect thousands of investors, you have them give you some money, and what you do is you select securities and create portfolios. And you might answer questions like, is this stock a good buy? Security analysis. How much should I pay for this bond? What's a fair price for this call option? And lastly, what is the optimal mix of assets in this portfolio? That's called asset allocation. So in these next 12 topics or so, we're going to answer all these types of questions, learn a lot about financial modeling and finance. Some of the principles we're going to encounter in finance, I've listed the top 5. Number 1, and we're going to learn that every single day, is focus on cash flows, not accounting profits. So the problem in finance is most of your data, your raw data, comes from accountants, and they give you financial statements, income statements, balance sheets. And as a finance manager, you want to make decisions based on cash flows. So we're going to talk about how to convert accounting profits into cash flows, because cash flows are what matters. Another principle is you demand a higher return for riskier investments. We'll talk about how we do that in principle. Another principle is $1 today is worth more than $1 tomorrow. So the idea of time value of money, that if someone gave me an option of taking $1 today or a promise of $1 tomorrow, I would take the $1 today. But if they offered me $1.05 tomorrow versus $1 today, well, I'll have to make that decision, make that trade-off, and that's called time value of money. Next, diversification is the only free lunch in finance. So we're going to handle this topic towards the last part of the set of topics. And what we'll talk about is in economics, I was always taught that there's no free lunch. In other words, everything involves a trade-off. All right, nothing is ever free. However, in finance, there's one free lunch, and that is diversification. By diversifying from one stock to, say, many stocks in a portfolio, you are better off, and there's no trade-off. You actually may decrease risk and increase returns. And the last topic we'll get to as we talk about stocks is you can't beat the market, so buy it. So that idea is it's very, very, very difficult to consistently beat the stock market. In other words, selecting stocks to beat an index like the S&P 500. So if you can't beat it, you might as well join it. So we'll just buy the market. All right, some of the top modeling principles we're going to cover throughout this set of topics is one thing, you want to put all the important variables, we call those value drivers, at the top of your worksheet. Don't embed them into formulas. Don't put them at the bottom. Try to keep them up top. Second, never use a number if a formula won't work. All right, we're gonna see that come up now, come back to haunt you whenever you try to change your spreadsheet. Like this next one, never ever ever combine a number and a formula. So if you're trying to calculate 15% of whatever's in cell A3, what I would do is set up 15% as a value driver and multiply it that cell times A3. You want to make sure you appropriately label, annotate, and show sources and assumptions and comments on your model. So when you go to look at your model a day later or a year later, you know what it means, and other people that work with you know what it means. And lastly, and one thing I'm going to use in this course set of topics exclusively are Excel styles. These are common styles that if everyone in your organization used, you can automatically see where are inputs, where are calculations, what are the key variables. So let's set up a very simple model here. We're going to set up a model to calculate the present value of $100 received next year. Remember I said a dollar is worth more today than tomorrow? Let's go ahead and calculate exactly what $100 is worth today. So we're going to go ahead and open up a new worksheet. So I'm going to just open up a new worksheet inside a workbook that I have. I'm going to go ahead and show my bar here. So I'm going to go up here and click on Show Tabs and Commands. I was hiding them to save some space. And let's just kind of get familiar with Excel. Here's when you do your File, Save, or File Open, or File New. Here's also you do your prints. These are called menus or tabs. So you have File, Insert, Home, Page Layout. That's where you set all your print areas and make sure it prints correctly. Some formula areas. We don't use that one too much. Some data. We'll use some solver and some data analysis later. So reviewing, we'll show a little bit of that later. Here's where I'll ink over my workbooks. Here's going to just change the view, so you can change the view if you want to see how it's going to print. A developer tab, you may not have the developer tab, but I'll show you how to get it later. You basically have to just go to File, Options, Customize Ribbon, and select the developer tab. We're going to use that when we write some VBA. All right, and here's a quick save. I use that a lot. Here's an undo, and here's a redo. All right, so let's go ahead and set up our set here. All spreadsheets are set up with rows are identified with numbers, and columns are identified with letters. So what we're going to do is we're going to set up a real simple spreadsheet. Let's call this the future value of cash flow, and I'll just put right here that's going to be $100. Now I want to put the dollar format, and what that does is it automatically creates a format, or I could have just typed 100 and clicked on a dollar like this. Now I'm going to, since this is an input, first of all, actually let me do a let's increase the size of this cell or this row or column. I'm sorry. I'm actually going to hit undo. Here's a little trick. If you want Excel to auto size a column, you can just double click right on the center there and it'll get the right size. And then I'm going to actually pick up this $100. I'm going to drop it right here. I'm going to make this a little bit bigger. Actually, you make it bigger and smaller by just holding your control button down and using a trackball on your mouse. I'm now going to click my $100. I'm going to set up that style as an input. Now here are Excel styles under the home menu. The ones I use all the time are calculation and input. Those are the two I use 95% of the time. The other one I choose to use are one of these themes, and I just pick the bottom left here, the blue. So the way I set up a spreadsheet is anytime I have an input, anytime I have an input, looks like my control button is stuck in. Let me try to undo that. There we go. All right. When I have my input there, I'll just go to Home, Cell Styles, Input, and then I have a few more inputs I want to put in for this model. Year, we'll call that variable N. All right. I'm going to actually call this variable FV. And I'm going to put in 1 year. Then we're going to put discount rate. I'm going to call that R. I got a little problem there. Anytime you try to put R in a parenthesis or a bracket, it turns into a copyright sign. So I just hit undo there. And then we have present value. That's the value today of a cash flow. I'll call that PV. So I'm going to have a discount rate of 10%. I'm going to put in 0.1. I'm going to click on percent, add a couple decimal places. I'm going to make both of these inputs, and then I'm going to calculate the present value of $100 received 1 year from now. How I do that is I'm going to use my formula. The present value is equal to a future value divided by 1 plus r raised to the n power. And that's how you raise something to an nth power in Excel. So I'm going to say equals the future value divided by 1 plus r to the 1 power. So that answer, I'm going to change that cell style to a calculation and change it to $1. So the present value of $100 received 1 year from now is $90.91. So this gave us some principles of Excel modeling. Here are my inputs, my value drivers. I use styles to show that these are inputs, and I showed an output here of a calculation. Let's talk about present value for a minute. All right, there's a bunch of interpretations of present value. All of these are correct. Present value is the amount of money that would be needed to invest today to create the future value. In other words, an interpretation of this $90 is you put this $90.91 in an account that earned 10%, you would exactly have $100 next year. So it's the amount you need to invest today to get to that amount given that discount rate. It's also considered the amount you would pay today for a future cash flow. So if someone offered me $100 next year from now, I'd offer them to give them $90.91 today. The reason why I wouldn't give them any more is because if I offered $91, I could invest that at 10% and have a little bit over $100. It's also the amount that would make you indifferent between the cash flow, the future cash flow, and the present value. In other words, I'm indifferent between receiving $100 in 1 year and receiving $90.91 today. And also, these present values are very important because what we're going to look at is a lot of different projects and a lot of different investments that have different horizons. In other words, the cash flows might be in year 1 or 2 or 3 in year 50. So it's hard to compare a lot of investments with different horizons. What this present value does for you, it allows you to evaluate every single cash flow, every investment, every stock, every bond, every project your firm wants to do. If you convert them all to present values, then you can compare them because all present values are comparable. Not all future values are comparable. All right, so we created our first financial model. So what we're going to move on to now is doing something called a pro forma financial statement. A pro forma financial statement is a forecasted financial statement. What that means, and by the way, the word pro forma is Latin for as a matter of form. So we talk about pro formas or financial forecasts. And what these pro forma financial statements do is you take a bunch of value drivers or assumptions. You start with some actuals, and then you forecast. So what we're going to do is, and also let me talk about the uses of pro forma financial statements. You might do this just to forecast the profitability of your firm. You might do this to forecast your funding needs for your firm. Am I going to need more cash to finance the growth? Am I going to need more cash to build a new building? We forecast free cash flows. So how much cash is the firm going to generate? Are we going to need to invest it? Are we going to need to borrow more? You could forecast financial ratios. What's our financial statements going to look like? And financial ratios going to look like a year from now or 10 years from now based on our current plans. We can also do common size financial statements. So you could forecast, say, the next 5 years and then represent all those values as a percent of totals, and then we can use that to see if the forecast makes sense. We can also use pro formas to value stocks and the entire enterprise value of a firm, and we're going to do that in the next couple topics. So right now we're going to forecast the income statement, balance sheet, and free cash flow statement for a firm called Whimsical Toenails. Now, I don't really like the title, but it's from Chapter 7 in the textbook, so we're going to go with it. All right, let's give a little tour of a financial statement. Here's actually the income statement. This is the balance sheet. Income statement has to do with flows. Balance sheet are balances. All right. So if we look at a balance or income statement, sales is always the top line, sometimes called revenue, and that's called the top line. So when firms say, "Hey, how is your top line growth looking. What they're talking about is sales or revenue. The bottom, almost the bottom of the income statement is called the bottom line, or earnings after profit, or net profit. So we talk about the top line and bottom line growth. When firms talk about that, they're talking about sales growth and net income growth. So if you just take your sales, you subtract your cost of goods sold, you get EBITDA. Take some practice to say that, but earnings before interest, tax, depreciation, and amortization. Earnings before interest, taxes, depreciation, and amortization. So it's a kind of a famous acronym in finance because it's used to kind of give you an idea of the kind of the overall or the early profitability if you just take your sales and subtract out your cost of goods sold and some other expenses. So we call that EBITDA. If you then subtract out your depreciation and amortization expenses, that's your D&A there, then you have EBIT, earnings before interest and taxes. And that's what generally people call operating profit. All right, now be careful though, because some people call EBITDA operating profit too, so there's no real definition, but most people call earnings before interest and taxes operating profit. If you then subtract off any interest on debt payments, right down here from the balance sheet, or add any interest on cash earned, again in your balance sheet, adding those interest components into there, you now have earnings before tax. If you then subtract taxes, we have earnings after tax, also called the bottom line or net profits. Now sometimes that's all it's usually reported if you look at a financial statement. However, we'll add 2 extra lines here. Once you have earnings after profit, if you then subtract your dividends, those are or extract your dividends off there, what's left over are additions to retained earning, and that's the connection between the income statement and the balance sheet. So once I figured out how much profit I've earned, say it's $100, and I paid $40 as a dividend to my shareholders, I have $60 left over. That $60 left over is then recorded as accumulated retained earnings and grows the equity balance of the firm. Now the balance sheet, you have assets, you have liabilities, and you have equity. So assets, some of the major classes are cash and cash equivalents. So cash might be actual cash in a cash register, but also might be something called cash equivalents, which are just short-term safe investments, like treasuries, very short-term bonds are issued by the governments. They're considered risk-free, but bear interest. You have other current assets. Okay, so cash and cash equivalents and current. You might have other current assets like accounts receivable and inventory. So accounts receivable would be sales in which you didn't collect any cash yet. So even though they're up here in sales number and generating profits, they're not really a cash item yet, so they're held here as accounts receivable. Inventory is also here. So you may have built some widgets or whatever you produce, and you haven't sold them yet, so they're going to sit on your balance sheet as inventory and current assets later to be sold and show up as sales. Then you have some fixed assets. So we're going to have 3 categories here to help our analysis. Fixed assets at cost. And fixed assets, we generally talk about PP&E, property, plant, and equipment. All right, so you might buy a piece of equipment, or buy a plant or build a plant, or you might buy some land. All those are recorded at cost in the balance sheet, but we'll call that fixed assets at cost. So every time you buy something, this number will go up. And then when you buy assets, and by the way, when you buy these PP&E, these fixed assets, we give that a special name. We call them CapEx, capital expenditures. So normal expenditures would show up here in the income statement because those are things that are short-term. But capital expenditures are long-term in nature. So we call those capital expenditures, and they sit on the balance sheet at fixed assets at cost. And then what we do is we depreciate the cost of those fixed assets, those long-term assets, over time. And how we depreciate them is they show up in my depreciation expense. All right, so my cost of goods sold, those expenses are recorded in the income statement every year, every quarter. However, when I buy a factory that's going to last 30 years, and I amortize it or depreciate it over 30 years, only say 1/30 of that expense will show up in depreciation each year. And if we take the difference between what we actually spent, the capital expenditures of my fixed assets, minus the accumulated depreciation over the entire lifetime, that's net fixed assets. However, a lot of times when I look at financial statements, all I see is the net fixed assets or the fixed assets lines. They don't show these two details. So these are my total assets. These are the assets that generate the sales that we have above here. Now, to generate these assets that generate these sales, you had to finance them. In other words, you needed to start with some cash to buy the capital expenditures, to finance the inventory to get the sales, and that's where this is recorded in the liabilities and equity. So in liabilities and equity, we have current liabilities, which might be accrued expenses, maybe taxes you haven't paid yet, but you know you owe someone, salaries you know you owe your workers, and accounts payable, goods you received from your suppliers you haven't paid yet. You also have debt. So it could be bonds and maybe bank loans. So bank loans are pretty straightforward. You borrow money from a bank at some interest rate. But firms, a lot of times what they'll do is issue something called bonds, which are just another form of loans. So a bond is just a loan. It's a loan in such that you pay interest each year, and at the end you pay off the loan. That's called a bond. If I take my current liabilities and debt, I have my total liabilities. By the way, sometimes current liabilities will include some portion of debt that's coming due in the first year. So it might be called the current portion of long-term debt. And lastly, we have stock. So this is the recording of stocks that were issued at cost. So you might issue stock to raise money. That money is then used to buy assets, just like your debt, your balances or your loan is used to pay off the debt. So this is your sources of financing. Mostly long-term is debt and stock. And then as the firm makes money, it makes money for the shareholders, the owners of the shares, and that sits here under accumulated retained earnings. So that's my total equity, stock and retained earnings. So now I have total liabilities and equity. And I have a line here. This doesn't show up in financial statements, but if I take the difference between liabilities and equity, the total, and total assets, they have to balance. That's why this is called the balance sheet. The balance sheet must balance. So we're going to forecast and make sure it balances. Let's now forecast our whimsical. So we're going to grab this spreadsheet. You can either double click and copy all the elements and paste it into Excel. So I'll give you 30 seconds to do that. Or you can launch the start file. So I'll give you a few minutes to do that. Alright, so here's my whimsical. I have my value drivers. Here's some actual rates from last year for certain items. Here's my forecast for next year. And what I have is an actual income statement, an actual balance sheet. I'm going to do some ratio analysis in a little bit. And then we're going to forecast free cash flows 3 different ways. And if I go to the right of my worksheet here, you also notice I have a section here set up to do a common size financial statement. So we're going to fill this in over the next few minutes. All right, so again, I have a way that usually financial models work is you have some actuals and some forecasts. So here's my year 1 forecast. These are my value drivers. And what you see is they're based on what happened last year almost exclusively. Looks like almost everything is except for sales growth. I'm going to use my own forecast for that. And I'm going to forecast my income statement. All right. So for what we're going to do is try to generate this income statement. So my first top line number, I need to forecast sales for next year. So sales next year, what you probably do is you talk to your marketing people, you talk to your customers, what are people going to buy, and you come up with, I think sales are going to grow by 10% next year. That's my value driver. So I'm going to say that sales next year, or this year's sales, times 1 plus that growth rate. So my sales are now going to be 11 million. Cost of goods sold, well, we're going to just assume is they've been running about 15%. I'm sorry, been running 50% of sales are costs of goods sold. So I'm making 50% margins there. So I'm going to put in And since I'm representing cost here as a negative, you don't have to do it that way. I'm going to put in my sales. I'm going to say equals sales times the negative of this 50% cost of goods sold sales over sales rate. So it's going to cost me $5,500 to generate those 11 million sales. And that gives me EBITDA, earnings before interest, tax, depreciation, and amortization of $5,500. Now, depreciation expense. Last year was $1 million. Now, what's going to happen this year is we're going to make an assumption on capital expenditures or new fixed assets. And what we're going to assume is this year, or in general, this firm is going to spend a little over 15% of its sales in CapEx, capital expenditures. So 15% of this 11 million, that's when it's going to be needed to buy new equipment or replace existing equipment. That's what's going to be needed to finance that growth. So I'm going to assume my depreciation, again, this is just an assumption. There's several different ways to do that. Is my depreciation this year is last year's depreciation, because there's lots of capital expenditures we had in the past, so we're going to continue to depreciate that. And then since we're writing this as a negative, I'll put a minus. Now what I need to do is figure out what this year's new CapEx is. Well, it's going to be 15% of 11 million. So that's going to be the total capital expenditures. I'll put a bracket around that. There's my total capital expenditures, but I'm not going to show that in the income statement. You don't show capital expenditures in the income statement. You amortize them or depreciate them. And we're going to assume that that new CapEx, that extra 15% of $11 million, is going to be amortized over 10 years. So we're only going to record 1/10 of the capital expenditures as an expense. So there's my CapEx for this year. Now I have earnings before interest and taxes, my EBIT or my operating profit. Now let's go ahead and do interest payments on debt and interest earned on cash. Well, write down, if you go to my balance sheet, the only thing I have really filled in is I assume right now that cash is last year's cash, plus I have a value driver of change in cash. Debt is last year's debt plus change in debt. And stock is last year's stock plus change in stock. So these are my assumptions on changing these three variables. We'll call those financial policy assumptions, but we'll just leave them 0 for now. So I'm just going to say that my interest I paid on debt, I'm going to put a negative sign, is going to be my tax rate, or I'm sorry, my debt interest rate, 10%, times the average balance of debt. So I'm going to type in average, and I'm going to put in last year's debt, comma, this year's debt. I'll take the average of those two numbers. So it looks like I'll have $320,000 of interest expense. I'm going to do the same thing here. I'm going to take my interest rate on cash, 8%, times the average of my cash balance. So it's the average of the cash in year 0. That would be the beginning of year 1, and the cash at the end of year 1. So there's my cash or interest earned on cash. That gives me $4,077,000 on earnings before tax. Let's go ahead and subtract out tax. I'll take my earnings before tax and multiply times the tax rate. 40% here, where it says tax rate. So there's my taxes. Now I have earnings after tax. So that would be my bottom line or net profit. And let's just make an assumption that this corporation pays out, so I'll put a negative, 40% of profits as a dividend. So that's how it rewards its shareholders. So I'll say minus, I take my 40% of, whoops, that's the wrong 40%. Let's take the dividend payout rate times my profits. There's my dividend payment for the year. And what's left over, that's going to go to the balance sheet. And we can plug that one in right now, since we're going to add additional $1.4 million to retained earnings. I'll go down to where it says accumulated retained earnings, and I'll take last year's balance plus additions to retained earnings. All right, so now I have an income statement done. We call this a first pass. And we're not going to play with, again, we're just assuming that cash, debt, and stock are last year's values plus any forecasted changes. So let's fill in the rest. Let's assume that current assets like inventory and accounts receivable are a constant percent of sales. So I'll take my forecasted sales times my historical current assets divided by sales. So now I have my current asset forecast. Now fixed assets. Remember when we forecasted up here the extra appreciation from CapEx? Well, I have to put that down here also. So my fixed assets at cost are going to be my last year's fixed assets at cost plus, now here's where I put in the new CapEx, 15% of sales. So there's my new CapEx. I'm now going to do accumulated depreciation. Well, it's last year's depreciation plus this year's depreciation. There's my depreciation. And so now I have total assets, 10,651. I'll then forecast current liabilities. Let's just make that, assume that's also a percentage of sales. So sales times my assumed current liability percent would make that 8%. So there's my current liabilities. I got 880. And looks like we're all done here. The only problem is the balance sheet is not balanced. We have assets of 10.6 and we're forecasting an extra funding of 11.5. So what's going on here is this extra $1.5 million of equity were generated, and it's sitting here in as a source of financing. You know, we could have paid it all out as a dividend, or paid the rest of this out as a dividend. However, we have extra financing for our assets. So our choices are, we're going to have to eventually decide whether we're going to hold that extra cash, hold it extra as a cash, or maybe I pay it all out as a dividend. But we'll talk about that in a minute. So what we have now is our pro forma income statement, first pass, pro forma balance sheet, but it's unbalanced balance sheet. And what we're going to do now is work on balancing it using financial policy. So what we're going to do is we're going to decide what we're going to do with our financial policy, and that'll allow us to do our balancing. So I'm going to make one assumption. Let's just make assumption. This is from the textbook too. Let's just say the firm has a desire to pay off some debt. So if you look at the current balance of debt, it is $3.2 million. The firm is going to pay down, as a matter of policy, $800,000 of its debt. So let's go ahead and put that down. Notice that $800,000 is now reduced from the debt balance, because that formula there is the prior year balance plus the change. Now that helps us almost balance, because by reducing debt, my liabilities and equities go down. So I'm almost in line now. So the question is, what do we do with the extra $110,000? Well, we can pay off even more debt. But let's just assume that we only want to pay off the $800,000. So let's put the rest back in cash. Now we have an extra $110,599. So I could put $110,599 in here. That would increase the cash balance. But notice it's not exactly balanced, because when I add additional cash and cash equivalents, when I add those, what they're doing is generating interest. So I didn't get balanced again. So I need to add another $1,593 back to cash, because I generated interest on that extra $100,000. So I'm going to take this number. I'll just say equals and do an add 1593. And looks like I'm almost balanced. The problem is that extra $1,500 generated interest, so I still have $22, so I can add another $22 to this cash. And looks like I have an extra $1, so I can add the dollar back. So it's called an iterative process for balancing the balance sheet. Because whenever time I play with bonds or cash, it's going to then have an effect on debt interest or earned interest. So I have to keep going back and forth. All right. So we could add that $1 back, and this would be our balance sheet. We'll call this our second pass. Now we could have solved this a little bit easier. Let's go ahead and change this back to 0 before we did our second pass. So we have an extra $110,599. What I can use is one of Excel's tools for solving iterative problems. We'll go to Data, What If, Goal Seek. What I could do is set an additional funds needed, that difference between assets and L&E, to 0 by changing the value in this cash cell. And it always has to be a value in here. Right now this is 0 in there. Hit OK. It's going to go through that process that we just went through. And it found that exactly $112,215 is needed to balance the balance sheet. So now this is our balanced balance sheet. Now I did want to show you one other thing. You could have a little advanced technique instead of running goal seek. In certain scenarios, you can replace goal seek with an iterative process, a formula. So what I'll do is I'm going to change that back to 0, cash. All right, now we're not balanced. I'm going to change this formula and create a circular reference. So if you're familiar with Excel, you know what a circular reference is. I'm going to make cash. All right, let's actually get rid of this. Make this cash change NA because we're not going to use it. Because I want to use a new formula for cash. And that's going to be equal to my total liabilities and equity minus fixed assets at cost minus current assets. All right. Notice it created a circular reference because the problem is liability or cash is a part of my total balance sheet, so it's creating a circular reference. So I'm going to go to File, Options, Formula, Enable Iterative Calculation, and it's going to try to solve my balance sheet. Let's try that one. Let's set this equal to 0 first. Sometimes I think the NAs were confusing it, and let's just do that again. Liability and equity minus fixed assets at cost minus current assets. And there we go. So now there's our 912,215, right? That's what we had last time. We can check that. 912,215. Now the nice thing about this formula is every time we were, say, what if we want to pay back $850,000 in debt? The balance sheet will automatically balance by figuring out how much it needs to plug to cash and cash equivalents. So I'll change that back to minus 800. All right, so that's a little trick you can use to do basically a goal seek for you as you set up a circular reference in Excel through an iterative process, tries to guess values that solves the problem. One thing you have to worry about is it will create, if you put in a parameter on debt, so you pay off too much debt, it can create negative balances in cash because there's nothing that constrains it to be a positive number. But that's okay. You just have sort of a liability sitting here in your balance sheet. mathematically it'll be fine. So let's talk about the one other lever we haven't used. Let's change this. Let's go back to 0. So we have we have some cash left over here. If I look at my additional funds needed, it looks like I generated an extra $1,700 in cash. So that's where it's all plugging if we didn't pay off our debt. But what if we decide we want to pay off some of our equity? In other words, buy back some shares. What if we put minus 100,000 under equity? Now notice, I don't know if you saw this happen, but I have a little formula here, which I'm just assuming, and I'm breaking a cardinal rule, but I want to do this just to show you. I have a formula here that the number of shares were last year's number of shares, 1,000,000 shares, plus the change in equity divided by, and this is, I'm assuming, a $10 per share stock price. So if we want to reduce equity by $100,000, we would buy back 10,000 shares. And I just have a formula that our actual shares go down. And notice the balance sheet is still balancing. Our equity balance goes down by $100,000. Our cash goes down by about $100,000. And the number of shares go down. So this is another thing that firms could do. They could issue stock if they have aggressive plans and they want to grow, say at a lot faster. It can generate more capex, and therefore you'd maybe issue stock or bonds by having positive balances here. In this firm, it's actually generating lots of extra cash, so it's actually going to pay off debt or equity. All right, so this is a basic process, and it's called my final pass once I incorporate my financial policy. So my first pass is just forecasting my financial statements and balance sheet without trying to balance it. Second pass might be trying to get the balance sheet to balance. Third pass is then incorporating any kind of changes to capital structure. When I talk about capital structure, that's changes in debt or stock. One other thing I just want to notice about when we're doing this equity buyback, I just did an example here. We bought back $10 or one share. The way we set up our plug here is that extra $10 just winds up in cash. So if you ever think about, well, what happened to that $10 if I bought back $10 in stock? Well, it would actually come out of cash. It would use the cash to pay off the shares. If we issued shares, it would show up as cash. All right, a couple other things we want to do before we wrap up is once we have our financial statements all forecasted, and I'm going to switch back here to the one in the textbook, which is we're just going to buy back $800,000 in debt. In that case, again, our financial statements look like this. And the problem with these financial statements, it's hard to see kind of what's going on here, right? So what we would do is maybe take these headers, these labels in two columns, but represent them all as percents. So what I'll do is copy those columns, and I'll take every item in the income statement, both years, and divide it by that year's sales. Right? Because it's really hard to see what's going on here, but if I take every single number here and divide it by sales, I then get a common size financial statement. And now you can see exactly what changed. Oh, depreciation expense went up as a percentage of sales. Operating profits went down as a percentage of sales. Looks like my interest on debt's gone down because I paid off my debt. Looks like my overall earnings after taxes are unchanged as a percent of sales. So that really lets you focus in on what's changed. On the balance sheet, it's really hard looking at these values what happened, but you can see really quickly what happened. My cash balance went up, generated more capex. Looks like my debt has come down from 32% to 22% of liabilities and equity, and my equity percent of liabilities and equity also was changed because that debt changed. So let's really focus on what changed. And then we can do some financial statement analysis. And I'll let you do that. All you can do is take operating profit, which is your EBIT, divided by total revenue or total sales. That's operating profit margin. So it tells you how much dollar of each revenue or sale turns into operating profits. Net profit margin takes your bottom line, your earnings after tax, divided by your sales. That tells you how much of each dollar sales winds up in the bottom line. ROA, combines income statement and balance sheet. You take your earnings after tax or net profit and divide it by total assets. And ROE, take your earnings after tax divided by total equity. So this ROA gives you an idea of how much each dollar of asset generates in profits. ROE, how much each dollar of equity generates in profits. I then can do some per share ratios. If I take your net income over a number of shares, I get the earnings per share. If I divide dividends paid over shares, I get the dividend per share. When I take the total value of equity divided by number of shares, I get book value of equity per share. So these are some per share items. It's good for shareholders to see. We got some financial risk ratios. If I take my EBIT, my operating profit, divide it by total interest expense for that year. So for example, if I had $1 of interest expense and $12.50 of operating profits, that would be a ratio of 12.5 to 1. That gives me an idea that I have lots of money to pay off interest. I am in no risk of defaulting on my bonds, because for every dollar I owe in interest, I have $12 in operating profits. My current ratio, current assets over current liabilities, that's more of a short-term measure of kind of cash needs. And total debt to equity. So it's the book value of debt, that's actually total liabilities, over total equity. Now, sometimes people will report debt to equity as simply the debt and not the current liabilities, but it's more common to have total liabilities over total equity. And lastly, I'll do some growth rates. If I took the percent change in the top line, percent change in the bottom line, those are my top line and bottom line growths, change in net fixed assets, and change in fixed assets. So you can see this firm is generating a big increase in fixed assets and generating bottom line and top line growth.